Brace yourself. The relentless debate over interest rates and global economic stability just took a dramatic turn that everyone is talking about. Even those skeptical of the impact that tariffs might have on inflation were jolted by July's sudden spike in U.S. producer prices. This surge, led by the largest leap in retail and wholesale margins in 2 years, has quickly dampened the feverish talk of aggressive rate cuts from the Federal Reserve. But here's the twist. What does this mean for your wallet, your investments, and the broader world economy? Suddenly, Treasury yields surged, the U.S. dollar gained strength, and the previously unstoppable climb in Wall Street equities paused. A latest PPI, Producer Price Index report, all but dashed hopes for a substantial half-point rate cut by the Fed next month. In fact, it's prompted some to question whether any rate reduction will arrive soon at all. The focus now shifts to a Friday packed with fresh U.S. retail sales figures and industrial production data, plus updates from the Fed's closely watched Jackson Hole conference next week. The burning question, can the consumer keep powering growth, or are economic engines beginning to sputter? Let's break down what's coming. Retail sales for July are projected to be robust, potentially rising 0.5%. However, expectations for industrial output are muted, and import prices are forecast to show little movement. On top of that, June inventory and a fresh look at consumer confidence for August will load up an already crowded agenda. Federal Reserve officials, including some of the most influential voices in monetary policy, have recently moved to decisively squelch chatter about a 50 basis point rate cut in September, a rumor reinvigorated by recent comments from Treasury Secretary Scott Bessent. But here's where it gets controversial. While Wall Street clings to hopes that rates might soon fall, stubborn inflation data keeps resetting market expectations. Who's right? The optimists or the skeptics? Chime in below. Next, global geopolitics enters the fray. All eyes are on Alaska, where former President Donald Trump and Vladimir Putin are meeting to discuss a potential Ukraine ceasefire. These talks, while uncertain in outcome, have fueled speculation about a last-minute nuclear deal, a face-saving way forward for both leaders. A breakthrough could signal Russia's return to global commodity markets after years of sanctions and international isolation. If Moscow re-enters the world stage, what could it mean for energy prices and supply chains? ROI columnist Gavin McGuire explores this in detail. Bold prediction or risky business? Meanwhile, Europe's major stock indexes and the euro both climbed on Friday, buoyed by hopes of progress in international talks. However, the European defense sector dipped by 1.5% while crude oil eased and gold prices stayed flat. Across the globe in China, investors shrugged off lackluster economic reports on factories, retail, and real estate, choosing instead to focus on the possibility of new stimulus, especially hints of government intervention to bolster struggling property developers. One of the day's biggest market stories, shares of Intel soared nearly 5% in pre-market trading. According to Bloomberg, the Trump administration is exploring a federal stake in the struggling chipmaker, hot on the heels of a meeting between President Trump and Intel CEO Lip-Bu Tan. Even after Trump demanded Tan's resignation amid controversy over alleged Chinese investments. Here's a question to stir debate. Should governments bail out their tech champions, or let market forces decide their fates? Elsewhere, Bridgewater Associates, Tiger Global, and Discovery Capital, the juggernauts of Wall Street's hedge fund world, have ramped up their bets on big tech in Q2, a response to the meteoric rise of artificial intelligence. But will this tech euphoria last, or is another bubble inflating before our eyes? The U.S. economy appears steady, but ROI columnist Jamie McGeever highlights 5 charts suggesting the foundation may not be as solid as it looks. Are investors ignoring hidden weak spots in America's economic armor? And here's a chart to ponder. China's factory activity just hit an 8-month low, with retail sales also slowing sharply. Policymakers face added pressure to unleash more stimulus and combat the chilling effect of U.S. tariffs. Even though new support for troubled property developers is rumored, the housing sector's issues persist. New home prices dropped 2.8% in July compared to last year, though the decline is slightly less severe than in June. Weekly reading that could change your thinking. Independence at risk? After repeated calls from Trump for Fed Chair Jerome Powell to resign, former Fed Vice Chair Roger Ferguson staunchly defends the importance of central bank independence. He warns that Powell stepping down prematurely could threaten the stability of the entire financial system. What do you think? Should the Fed chair be shielded from political attacks, or is accountability overdue? Who polices the bond market? European central bank researchers recently pointed the finger at investment funds, who control up to a quarter of some euro nations' debt, as the main market vigilantes when times get tough. Interestingly, while foreign funds are more likely to sell in volatile times, domestic investors often buy what they dump. Are these funds stabilizers or troublemakers? Debt dilemma. IMF economists revisited the relationship between government debt and interest rates, finding that for every 10% increase in expected debt relative to GDP, long-term borrowing costs rise 20 to 30 basis points. Deficits and debt really do matter, despite the deficit doesn't matter crowd. European spending strategy under scrutiny. Fresh analysis suggests that Europe can't just throw billions at investment projects and expect booming growth. Using Japan's history as a guide, Daniel Groh argues that the quality and focus of spending, especially on startups and innovation, is far more critical. More money isn't always the answer. Do you agree? Dark Side of AI. A revealing investigation uncovered that Meta's AI chatbots were internally permitted to engage minors in romantic or sensual conversations. A detail that highlights new dangers in the AI boom. Is regulation falling dangerously behind the pace of technological change? What to watch today? A batch of U.S. economic releases, July retail sales, import-export prices, business inventories, industrial output, and the latest University of Michigan Consumer Sentiment Survey. The high-stakes Trump-Putin summit in Alaska, which could redefine the global landscape. Finally, what's your take? Is the Fed making the right call, or setting us up for a nasty surprise? Could a new U.S.-Russia deal shift the entire global order, or is this just another headline that will fade? And with AI's dark sides now coming to light, should there be tougher rules before these technologies go mainstream? Let us know where you stand in the comments. Agree, disagree, or want to challenge the mainstream view? We want to hear your thoughts. Stay tuned, because the next big shift may be just around the corner.